Mike Muller, head of Vitol in Asia. Mike, $75 Brent sort of stuck there, give or take a few cents each day. But ultimately, is this news of the week essentially another piece of just geopolitical risk factors that you put in the geopolitical risk bucket? And we've sort of coming to an end of the year when, despite all the noise of the backdrop of conflict in Europe and the Middle East and so forth, and a few brief moments where the oil markets have spiked on geopolitical tensions, ultimately the market is unperturbed by geopolitical risks. Your thoughts on this decision, on this news this week, and its intersection with the oil markets?
Yes, John, I guess it's fair to say that a lot of the geopolitical tensions have posed a risk to energy supply infrastructure, but then what's actually borne out is that energy supply infrastructure was unaffected. The major disruption we continue to have is the threat of attacks on passages in the Red Sea, the Bab el Mandab. And other than that, there was some concern about gas producing infrastructure in the southeast corner of the Mediterranean, close to Israel and Gaza. But it was quite telling when the Israeli strikes occurred that no energy infrastructure was targeted. And as a result, that calmed the market very, very quickly. And the what we call the cold skew, the upside protection the market was paying big insurance premium for in options markets, very quickly went away. Of course, we now have the prospect of yet further retaliatory strikes, and that is still priced into the market, I think, sitting here at just shy of $75, and of course, it's been closer to 80. So we're at a price level that does not necessarily reflect what I would say is a consensus view that next year, all things being equal, there being no disruptions and no geopolitical impairment of energy production, there is the risk of a build in inventories, which will pressure the oil price. So the question then is how much of the current price is geopolitical risk premium? Yeah, the debate is out on that. I think it's also fair to say that there's been much more movement in markets other than energy, other than oil, as a result of the US election. And then the other thing that has been on in the headlines this week is, of course, the meeting of the high-level plenary in China to give yet more stimulus to the Chinese economy. And there also the impact on markets has been plus minus 1% on various indices. So, yeah.
This week obviously kicked off with OPEC Plus deciding to postpone their increases from, again, they had originally postponed from October 1st to December 1st. And then this Monday passed, they increased, or they had extended to January 1st. That's really what moved the oil market this week in the earlier days of the week when it sort of came up from the low 70s to the mid 70s and is kind of held there, propped up by that, it would appear originally. Your thoughts on where this all lands with supply and with OPEC Plus decision making?
Yes, that's a pretty clear one. Indeed, there was a lot of talk of it happening as a possibility before the weekend. And then on Monday this week, it came as a confirmation. Now, there was a huge range of estimates of how much production was actually going to come onto the market incrementally. The actual number, of course, the headline number is quite substantial, and therefore it came as a tonic to the market that was worried about oversupply, that that OPEC Plus wouldn't be pushing this extra volume into what looked like a fragile market in December. And I think it was good for $2 a barrel in the early part of the week. Something very strange happened though, because normally what you get is a war risk premium, or let's be more specific, a risk of infrastructure damage premium coming into the market in the shape of options call skew. People wanting to buy call options more than people wanting to sell them. And the call skew went up on Monday as well. And that normally only happens on Fridays when there's a big long weekend. And it has been a historical fact that the protagonists have chosen to lob missiles at one another at weekends when markets are closed. So that was unusual, and therefore had some people suggesting that there was a view that there was a higher risk of retaliatory efforts or indeed a follow-on strike from the Israelis. And that was also cooking the market into from the low 70s to the mid to high 70s. As far as supply demand fundamentals are concerned, the overriding picture is that OPEC Plus will continue to be challenged next year because the projections for demand have been edging down, largely on concerns around China. That's balanced, of course, by the fact that global inventories of products and inventories in China in particular are quite low. So there's been a destocking effort going on. And as a result, we've had a period of stock draw, which is got to be seen hand in hand with a pretty certain outlook for 2025, where we will see a stock build. So the world doesn't really have a call on incremental OPEC plus production if the numbers are roughly as follows. Non-OPEC production coming into the market, largely from the Atlantic Basin, at about 900,000 barrels a day incrementally next year. And demand for products in total may be a shade over 1 million barrels a day, but of that, a good 300 or so is NGLs. In other words, demand for refined products made from crude oil, such as OPEC plus crude, is roughly the same as the supply from non-OPEC sources. And as such, there is, on paper, little room for OPEC Plus to increase production unless demand looks a lot rosier. And with demand projections having been revised downwards incrementally this year, not just because of China, that it was a concern to markets to see OPEC Plus setting about with intent to put more production into the market. The one thing that is needed, and this also applies to gas markets, is a cold winter to give a little bit of a tailwind to those bulls that wish to see
Which
prices
we're not
stabilize.
getting yet, right? It seems winter's warm so far.
But since markets
Oh,
price everything in that we know, I don't think too many people are unhappy with today's price.
just Mike, a quick follow-up on that. The other thing that happened after the decision by OPEC Plus to postpone their increase, we had the Saudi OSPs, which came in at a discount into Asia. I just wanted to get your thoughts on that.
I mean, very often people read a lot into those in terms of whether the Saudis wish to see people happily nominate more because they think the OSP is reasonably priced. Um, but the pattern for much of the last 2 years has been one that totally gels and makes sense, with the Saudis being the swing producer and essentially being the major factor behind OPEC Plus, helping support prices by keeping volume off the market. So Saudi have been able, via their policy and their OSPs, to set the OSP at levels that most refiners complain about, and that is quite purposely done because there's less Saudi in the market than there could be, right? I don't think this last round of OSPs gave me any cause for concern or surprised in any particular way.
Mike, one of the big stories that came out of ADIPEC, where I've been all week, was all things data centers and the intersection with nuclear power. It was the headline of the ADNOC CEO's opening address of the week at ADIPEC, and this unexpected surge in demand for power to feed AI data centers and the rehabilitation, which we've already seen in the last month or two, or recent months, the rehabilitation of some nuclear power plants in the United States, sort of taken on by, I think, was it Facebook or Microsoft, or individual companies basically taking on individual nuclear power plants. I wanted to get your thoughts on that, just this sort of demand surge from the data, AI, nuclear, and how that might play out as we go forward into some energy policy making. Your thoughts on all of that, Mike?
Well, Sean, I follow your social media posts, and you
Yeah,
also tweeted or posted that an average AI chat GPT search consumes 10 times more power than a conventional Google search on the same matter, right?
yeah.
So it's something that the industry's been following for some time now, which is the demand for power for these search processes and what that means in terms of extra data centers. And of course, data centers need to be located optimally, both in terms of where there's demand for them, but also where energy is not just affordable, but reliably so. And in many cases, there has been talk of some of the major consumers of data center hardware considering small scale nuclear side by side. More conventionally, over the past few years, we've been looking at wind farms and solar farms co-located with data centers and indeed batteries. So that has been the typical constellation. So this is quite a new concept to have lots of small scale nuclear facilities powering these large data centers. That was more of a US thing. I saw Dr. Sultan Al Jaber's speech, but I wasn't at ADIPEC myself. So, yes, I can relate to it. And the real question is where do we go with the energy mix? There are obviously some parts of the world that are less happy with nuclear. And we still have a major intermittency challenge in terms of the transmission capacity, the grid capacity to cope with the intermittency challenges from, in some cases, alarmingly fast build out of renewables.
Looking forward, and the other big story this week that surfaced is the price of money and the Fed sort of back in the crosshairs of the Powell versus Trump barrage that we had during the Trump presidency. The price of money, and at ADIPEC, I was hosting the ADNOC Trading Forum, and one of the reasons that came onto the stage about perhaps why there was a declining performance of the oil price this year was the fact that the price of money had was quite high, and it may now come down. It is coming down. Your thoughts, Mike, on where that impacts the energy markets, the price of money and trading, and the idea to go forward as price of money declines?
Yeah, two things. There's the classic correlation between the dollar strength or weakness and the oil price, and those are inversely correlated. Interestingly, of course, on the election of the Republican of Donald Trump, the dollar went up and so did oil. But it has now stabilized. So I guess that's it's more of a stock market thing. But then the cost of money, I think what you mean is the cost of borrowing, right, and financing
Yeah,
projects.
yeah, yeah.
And of course that's seems to have peaked. So the prospects of inflationary worries are perhaps a little bit mitigated, a little bit less than they were before. But it does clearly feature in people's ability to create leveraged IRRs, leveraged returns on projects that become more attractive if your cost of borrowing for a medium risk country is maybe 7, 8, 9%. And that definitely eats away at the capacity of the market to bring to market fresh FIDs on projects. Now, if you're talking about traditional, relatively low cost provinces such as deepwater Gulf of Mexico, USA, or maybe in the gas case, offshore Northwest Australia projects, you have a little bit less risk involved. But I think it will weigh on people's economics in a way that it didn't when interest rates were negligible.
What about on the actual trading process? By trading houses, obviously you're in a very big one and has obviously lots of access to capital. But for the industry as a whole, accessing that kind of credit line at those kind of prices, does it impact liquidity?
Well, I would say there's no issue with securing revolving credit lines from the lending institutions to commodity trading.
But
But
being able to afford
2020,
it is the problem.
yeah, well, 2021, 22 taught us a few things that many hadn't perhaps realized, which is that the cost of trading is not just interest, but it is also the margining requirements, not just the need to stump up money overnight when exchanges like TTF double in value, but those exchanges look to secure their adequacy by imposing huge initial margins. And that requires trading companies to come up with billions of cash if they're major players in certain commodities, such as LNG in the example I'm citing. So I'd like to think that the industry has derived some learning from that and put in place larger swathes of tranches of cash, which may cost a little bit more to have for such a rainy day or such a volatile outcome. But sure, no, I don't think that a 5% interest rate environment, as opposed to a 3% interest rate environment, has materially impacted people's ability to trade and have credit lines to trade with. It's more of an issue in terms of weighing on marginal projects
Right.
in sort of traditional low risk infrastructure in energy, where maybe a 9% return was quite okay when the cost of borrowing was 2%, but now it's not okay. Yeah.
Mike, last word to you on China. But one of the big stories out of China in recent weeks is the stimulus, these announcements to try and stimulate the Chinese economy out of what generally appears to be some element of malaise. Your thoughts on that stimulus so far? Is it working? What does it look like going forward? How committed and how big do you think the Chinese are willing to go, and its impact on China's energy consumption?
Yes, the measures coming out this week have been less profound than the ones that came out a month and a bit ago, which really sent or 2 months ago, I guess, which really sent the stock market into quite a buying frenzy and had the impact of making the middle classes of China feel a little bit more affluent and spending more. But what's the impact of this week's plenary meeting? I mean, we have various metals like copper, ferrous metals down 1.5%, 2%. Equity markets are down a little. So it hasn't had quite the same impact. And these measures are really designed, I think, to tackle local debt issues and to contain or counter downside risks to the economy. There has been a tendency to do a bit of GDP window dressing at the end of the year, but they are looking to fix the ailing construction sector. It's the same old, right? So the last set of stimulus measures that sent the stock market soaring didn't do much for energy, but did something for certain industrial measures. One has to think that perhaps they might have held back in light of the political news out of the US also to have a little bit of running room left in the eventuality that there's talk of tariffs as soon as Trump assumes the presidency, which is what many people are assuming, of course. So yeah, I think there may be more to come. China has been quite important in shaping the mood here in Asia. I think it's fair to say that Asian oil products markets are more bullish than the rest of the world. In fact, they've been surprisingly strong. We've got markets in backwards structure, both in crude and in most products. And whilst the petrochemical feedstocks market is pretty weak, distillate's been impressively strong, as has jet fuel. And part of the reason for that is that China is not exporting as much to the world because of a limitation on export licenses. So how long that continues, I don't know, but it's certainly rescued refining margins from being woeful a month ago to being quite okay now, and giving people pause to say, well, hang on, those run cuts, maybe we try and reverse them. And whenever that happens, of course, people come knocking at OPEC plus for marginal crude supply, and that helps the sentiment a lot.